Hello, I'm Greg Brown. I'm a partner at Katmuch and Rosenman here in Chicago. I've specialized in employee stock ownership plans for 37 years. I work with private clients. I also work with them on their employee benefit plans and their executive compensation arrangements. I'm going to talk to you about ESOPs as an exit strategy, something that's used in succession planning, because as you know, all of the advisors to privately held companies come to a juncture where their client has needs for succession planning and ultimately for an exit strategy. Now, this is because they're not going to live forever, they're not going to work forever, and at a certain point the seller and the seller's family are going to need liquidity and diversification. Now, we all know the usual strategies that are employed in order to get to the succession planning and exit strategies. For example, we're used to seeing clients have shareholder agreements where there are non-family shareholders, to deal with succession planning. Sometimes we look at third-party sales to strategic buyers, sometimes to private equity groups or financial buyers. Sometimes we even look to doing an initial public offering. And sometimes we even look to strategies involving charitable giving and charitable remainder trust. My purpose today is to tell you there's another alternative that you ought to consider when you're advising your private clients, and that's an ESOP. And an ESOP is an acronym for Employee Stock Ownership Plan, which is a tax-qualified retirement plan. Why would they consider an ESOP as an alternative? Well, simply stated, it's because there's some significant tax advantages for both the company as well as the selling shareholder. For example, I've worked with a number of clients who have C corporations, and under the right circumstances, if they sell at least 30% of the equity to the ESOP, they're in a position to elect a tax deferral on the gain on the sale. This is significant because it allows them to keep 100 cents on the dollar of what they sell to the ESOP. From the company point of view, there are also some significant tax advantages. When the ESOP buys the shares, usually on a leveraged basis, it's going to take company contributions to help the ESOP pay back the principal and interest to either the selling shareholder of the bank or to the company if it's the lender. The company contributions to the ESOP to enable it to do so are all tax deductible to the extent of 25% of covered payroll as well as interest. This is a big difference from a corporate redemption, which is not at all tax deductible. This is why I would encourage you from a tax viewpoint to think about an ESOP as an alternative for succession planning and an exit strategy. There are other reasons. I've had a number of clients want to keep the continuity of the business, keep the family name on the business. Using an ESOP allows the company to continue as an independent entity, possibly with the family name on the name of the business. This is significant to some of our clients, and sometimes it's more important than the money itself, although of course the money is important. Now, in doing an ESOP transaction, the seller does not have to sell all of the family equity to the business. In fact, if it is contemplated that that's going to be done, it can be done in stages or it can be done all at once. Most typically, it's done in stages. Usually the first transaction involves a sale of 30% or more to allow the selling family to be able to elect the tax deferral on the transaction. Now, you might ask yourself, is this going to be an expensive and costly process? The answer is no. It's not going to be any more expensive than any of the other strategies that we would employ. For example, it'll be no more expensive than a third-party sale, merger, certainly a lot less expensive than an initial public offering. You ask, well, what about other estate planning strategies? Well, the ESOP can be folded right within any other strategy that you're used to using for estate planning purposes. For example, the proceeds of a sale of an ESOP can be put into a charitable remainder trust for the family. Family limited partnerships can be consistent with an ESOP. So you don't need to worry about that. How do you get started with one of these? We normally suggest that you employ a qualified person that can perform a feasibility study. This won't be terribly expensive, and it will tell you whether the ESOP is an alternative that you need to consider as an advisor to your private client. Thank you.